Thursday, July 30th, 2020, Maneco 64, home of alternative economics and contrarian views. So Jay Powell made a comment yesterday, Jay Powell, the chairman of the Federal Reserve Board. That reminded me of the previous chairman's remark, Janet Yellen, when talking about unwinding the balance sheet or quantitative tightening. She said that it would be like watching paint dry. Well, yesterday, Jay Powell said very factly that they've used loads of tools from their toolkits, all the programs, and all they need to do when things are better is to put their tools back in the toolkit. And he made it seem so simple. He made it seem so scientific, like he's like Jay the Builder or Bob the Builder. So yeah, I think he's deluding himself, of course. He's out of his depths. And that's why we're going to continue to see precious metals continue to rise versus the dollar, versus the euro, versus the yen, versus all fiat currencies. And you can sense that the central bankers are at the end of the road, and they're of course using the current crisis that we have, that I don't have to tell you what it's called, to they're using it as an excuse, of course, to justify their crazy monetary policy where rates are at zero or negative, where they're creating reserves, because that's technically what the Fed does. It creates reserves out of thin air, which it lends to the banks at, well, no rate really, at zero almost now. Then the banks take that and they create loans, which produces the money for you and me and the big corporations and small corporations or small businesses. And that's why M1 money supply is rising so quickly. That's why M2 is rising so quickly. And that's why we're going to continue to see fiat currencies devalue. It's the simple law of supply and demand. That's all it is. One thing I noted yesterday and also this morning is the fact that they're trying to tell people and the markets that they're going to keep rates as low as they need to. Someone asked them in this Zoom press conference, it looked quite weird, all the people in the little squares, about raising rates. And he had to say, you know, I said that a few weeks ago or a few months ago, that we're not even thinking of raising interest rates. So nothing's changed. And my feeling is that you need to, not worry about it, about the price movements in the paper markets. Especially silver is getting very, very choppy. It's very, how can I say, it's a market that's going to make huge moves up and down, but the trend now is higher, I would say, for silver. And how do I know that? Well, because I've been in these markets for a long time. My background is in the city of London. I remember trading silver futures for a client back when silver was in the big bull market in the mid-2000s. And yes, the moves we're seeing now are normal, so I wouldn't worry about it. And I bet if you went to your dealer to get some silver this morning, the price wouldn't have changed too much. So these are just paper prices. So that's what I got from the Federal Reserve. And that's what I think we're going to keep getting, not only from the Federal Reserve, but also from the other major central banks like the ECB, the Bank of England, the Bank of Japan, and all others. The other interesting thing that the Federal Reserve noted yesterday is that they're going to keep the swap lines open for foreign central banks and also a repo facility for foreign central banks. So if they have a shortage of dollars, that they can go and borrow or swap those for those dollars at the Federal Reserve Bank of New York. And why does the Fed have to do that? Well, because it's the reserve currency, and it's what backs all the other fiat currencies. And that's why I keep saying, yeah, the dollar is going to continue to weaken versus precious metals. The dollar is, how can I say, accelerating on its way lower versus real money. But don't forget, the hedge for that is not to get into other fiat currencies, because other fiat currencies are also going to collapse versus precious metals, and they're doing so as I speak, as I said yesterday. So let's see where the markets are this morning. It's 8:18 a.m. Billy's not here right now. He's upstairs, but I'm in a different room this morning. So yeah, we're seeing the markets reverse here. We've got gold right now, right near the lows. It's down $18 at 19.52. As I said about a week ago or 10 days, that it would be very positive if gold could close the month, for that matter, above 1825, which was the highest monthly close that we saw in 2011. So, and we are here at 1952, so I wouldn't be concerned. We did get up to 1981 yesterday during the Fed press conference after the Fed announcement. That had been the high the day before in 1981. Silver is down 93 cents, down 3.8%. Why is that? Well, because silver moves like that. It's a very volatile market. It's still at 23.37. Don't forget, the key level for us to close the month, I would say, is around 21.15. As I've said before, it's called a bull market because it's hard to stay on that bull, because it's really an excited bull, right? An aggressive bull. We've got the Dow future down 152 points, or just over 0.5%. We've got S&P down 20, down 2/3%, and we got the NASDAQ 100 future down 58. So the stock markets are not doing very well. We've got the fiat currencies today reversing some of their recent gains. We got the pound down 1/3% at 129.58. We got above 130 late yesterday and earlier today. That's a huge move the pound has made versus the dollar since the crisis in March. We got down to around 114 and now we're at 130. But has it been good to hold pounds versus the dollar? It has, but it has been even better to hold gold versus the pound. The euro is at 117.54, down 1/3% as well. And the dollar's up 1/8% versus the yen at 105.06. Dollar's pretty much unchanged against the yuan. It's at 7. Crude oil is down 1%, just below 41. The bond market. So we're seeing the short end make new lows here, recent lows. We saw yesterday during the press conference after the announcement by the FOMC that the short end of the curve came off a little bit in terms of yields. As the Fed reassures the markets that rates are going to stay low. So we've got the 2-year yield here, which had pretty strong support around 0.15. We're now at 0.129. That doesn't seem much, but it's quite significant. I think that the 2 years gone through that 0.15. And we've got the 10-year down 1.5 basis points at 0.57. If you remember well, that 0.6 level had been support for weeks. So now we've broken through there. That's giving us a signal that things are not well with the economy, and that central banks are going to keep stimulating monetarily. They did ask Powell about the fiscal help, and he said, I can't tell Congress what to do, but he made it clear that he wants Congress to come out with more stimulus, even though when he goes to testify in Congress a couple of times a year, he keeps reminding Congress that they need to rein in deficit spending and that eventually they need to do something about the debt. But at the same time, he's encouraging them to take on more debt. So it's just a sham, really. The Federal Reserve and Congress, they're working together to indebt the American public even more. The other interesting question someone asked was about wealth inequality, and Powell admitted that the U.S. has had a problem in the last 40 years or so with wealth inequality, but he said that monetary policy was not the reason for it. And I was surprised by that, or maybe not, because he doesn't want to tell the public one of the reasons why there's more wealth inequality is that the general public, the lower paid workers, they get paid in money or currency, fiat currency, that doesn't hold its value over time. And why is that? Well, because Richard Nixon and FDR before that have been taking the monetary system off a sound footing. Well, in 1933, domestically, America went off a gold standard when FDR banned gold ownership. And then in 1971, Nixon closed the gold window and America went off a gold standard internationally. So I personally think that's one of the big reasons why there's more wealth inequality, because the very wealthy, the people at the top, they're better suited financially to protect themselves against inflation, while the general public, the working people, they're not. So they keep getting paid in these depreciated pieces of paper. They're told that there's no inflation, which is basically a lie, really, because inflation is the creation of money and credit. They're given these statistics and they say, oh, look, there's only 2-3% inflation, CPI, which is bad because if you do 2-3% over 20-40 years, the money loses a lot of value. So, and we're also told by people like Powell that unless we have inflation, the economy will collapse, which is a load of baloney. As I've said many times before, as I've looked in the Bank of England inflation calculator from 1820 to 1914 in the UK, the rate of CPI, and I'm not going to call it inflation, was 0.1 negative. And was the UK, was Great Britain in a depression from 1821 to 1914? No, it wasn't. So there you go. Yeah, hold on to your precious metals. Trading, of course, these markets, especially the futures or ETFs, the paper is something different. Also the mining shares are very volatile, but I think the trend is still higher, of course. There's no end in sight to the inflation, courtesy of Jay Powell and his friends at the Federal Reserve and all the other world central banks. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.